Yeah.
Let's get into
Excellent.
my
All right,
segment.
let's move on. The next segment, Brennan's going to look at. What are you looking at this week,
I'm
Brennan?
looking at that
The
Fubo
SPAC
TV.
King. I'm just kidding. What?
I'm
Oh
looking at
yeah,
Fubo
you're looking at
TV.
Fubo or whatever.
Fubo.
Fubo TV. Have you ever watched it?
I haven't. No.
No.
I've heard of it before, but yeah. So we got an email from Michael, and he says the company gapped up from $1.50 to $4. What are your thoughts? So Fubo TV Inc. FUBO on the New York Stock Exchange, currently trading at a price of about $3.71, about a $1.2 billion market cap. They do not pay a dividend, and essentially they provide a sports first pay TV replacement product. For offering subscribers access to tens of thousands of live sporting events annually, as well as leading news and entertainment content, both live and on demand. A majority of the business's revenue comes from its subscription services. So, as Michael notes, the stock did gap up from $1.50 to approximately $4 in January following the news that Fubo TV ended its antitrust lawsuit against Disney, Fox, and Warner Bros., which is essentially just Discovery, and that the Walt Disney Company entered into a definitive agreement for Disney to combine its Hulu Plus live TV business with Fubo, forming a combined virtual multi-channel video programming distributor company. And under the terms of the definitive agreement, Disney will own approximately 70% of Fubo, and Fubo will continue to operate under its existing management team. Now, regarding the litigation, Fubo settled with Disney and ESPN related to Venue Sports, the previously announced sports streaming platform planned by ESPN, Fox, and Warner Bros. In connection therewith, at signing of the transaction, Disney, Fox, and Warner Bros. Will make an aggregate cash payment to Fubo of $220 million, and Disney has committed to provide a $145 million term loan to Fubo in 2026 as part of the transaction. So that's why the stock was essentially up, and the Fubo TV merger proxy meeting is scheduled for September 30th of 2025, so just a few weeks from now. So shareholders as of record on August 6th will be eligible to vote on the business combination agreement in September here. Now, looking at the last quarter ended June 30th, 2025, revenue was down 3% year over year, and there was 1.356 million paid subscribers, which was down 6.5% year over year. Net loss from continuing operations in the second quarter was $8 million, or a loss of 2 cents per share. This compares to a net loss from continuing operations of about 25 or 26 million, or an EPS loss of 8 cents in Q2 of 2024. Now, adjusted EBITDA was positive 20.7 million, representing the company's first positive quarter of adjusted EBITDA, and free cash flow was a loss of 37.7 million. Now, if we look a little longer term on a quarterly basis, we can see that operating income, net income, EBITDA, and cash flow have been negative for the majority of the time. But the last quarter does appear to be a decent improvement. I'll also note that in Q1 2025, ended March of 2025, the large gain in net income as well as cash flow was actually due to a gain on that settlement of litigation, which boosted earnings. That $220 million payment I referred to earlier. And looking at the most recent quarter, the company did have net debt of 91 million, and its share count was now up to 342 million shares outstanding, up from 311 million shares at the same period last year. And because the company has negative trailing EBITDA, we cannot calculate its trailing net debt to EBITDA multiple on the business. So clearly here, the company has been issuing shares to keep operations afloat. And just to show, again, EBITDA and free cash flow were both negative over the past trailing 12 months. Here's the valuations. Just quickly looking at the valuations, if we adjust out the gain from the litigation, all of its valuation metrics are negative on an earnings basis and cash flow, given its lack of earnings and cash flow. So, looking just on a trailing price to sales multiple, the business currently trades at just 0.7 times sales. And to conclude here, so the reason the stock gapped up in January from $1.50 to $4 was due to the end of its antitrust lawsuit against Disney, Fox, and Warner Bros. Plus, the Walt Disney Company entered into a definitive agreement for Disney to combine its Hulu Plus live TV business with Fubo, forming a new entity there. Now, financially, the businesses hasn't been really performing that great. Top line revenue growth has been there, but there's really been no real profitability in cash flow. Although there was positive adjusted EBITDA in Q2 2025, which is decent, the trend in profitability hasn't been that great. Plus, again, the business is in a net debt position and rapidly has been increasing its share count given the lack of profitability. Now, the new entity with Disney owning 70% may be intriguing, but it's tough to know what the business's forward fundamentals will look like. If someone asked me if the deal wasn't possibly coming down the pipe, would I invest in Fubo? I would say no, as the fundamentals are relatively lackluster, in my opinion, with no profitability, further dilution, net debt balance sheet, just things that we don't love to see. So, we'll see how the vote goes in late September for approval of the merger. I think that there's, speculative potential for the new entity. But again, it's tough to tell how the forward fundamentals will look, and risk is certainly high. It's not something that I would personally be betting my own dollars on. And here is disclosure.
Yeah, and anytime we see a company like this where you're betting on something in the future and being able to integrate and being able to be profitable under that, you're always putting that next to what else can you put your investment dollars in. There's always alternatives. And when we can see businesses that have good current fundamentals, good current balance sheet, and the same amount of potential upside or similar upside or even greater upside, that's not to say that this company isn't potentially a decent speculation. It's just to say that we can invest in a company that has less downside likely and the same type of or more upside. And that's what we're looking for, because it's not about just finding companies with upside. It's about finding companies with less downside too. So, and in this case, there's a lot more speculation here than we would be comfortable with investing or telling our clients to invest in at this point. Again, doesn't mean this is a terrible investing or company to invest in. It just means we think there's too much risk for the potential reward. You can find less risk for the same commensurate or higher reward. That's what we're looking at.